Stop. Before you make another investment decision, I need to show you something that changes everything about protecting money from inflation. I'm about to reveal which investment destroyed the other by a factor of 18 to 1 over the last 50 years. And I guarantee you, 90% of people get this wrong. They choose the loser and wonder why they're broke 30 years later. Here's what's crazy. The investment everyone swears protects against inflation, the one your grandfather told you to buy, actually lost to inflation. People held it for 20 years and watched 85% of their purchasing power evaporate. Gone. While thinking they were being smart. Meanwhile, the investment financial gurus call risky and volatile has beaten inflation by over 3,000% in the same timeframe. Not a typo. But here's the twist. There's a specific 12-year period where everything I just said reversed. Where the loser became the winner. And if you invested during those years, you'd come to the exact opposite conclusion. You'd think I was lying about everything. I'm talking about the most controversial debate in finance, index funds versus gold. The argument that ruins friendships and starts fights. By the end of this video, I'm going to show you the one number that changes everything. The number that determines your retirement. A number that will decide whether you retire with $180,000 or over $1 million. Same starting amount. Same time frame. Completely different outcome. But first, I need to show you what happened to two identical twin sisters who made opposite choices in 1980. One became wealthy. One lost almost everything. And the only difference was this one decision they made with their inheritance money. Stay with me. Because what I'm about to reveal will change how you invest forever. This isn't theory. This is real data. Here's the question that ruins friendships and starts arguments at dinner parties. If inflation is destroying cash, what should you own instead? Gold investors have their answer ready. They'll look you in the eye and say gold is the only real money ever created. It's been valuable for thousands of years. You can hold it. Governments can't print more of it. When currencies collapse, gold is king. They sound confident. They sound smart. And here's the thing, for certain periods of history, they're absolutely right. But keep watching. Index fund investors have a completely different story. They say stocks represent real businesses. When inflation hits, companies raise prices. Revenues grow. You're not just protecting wealth, you're multiplying it. They also sound confident. They also sound smart. And for certain periods, they're absolutely right too. So who's actually right? Here's where it gets interesting. I'm going to show you the data. But not yet. First, understand why this matters. Let me tell you about Sarah and Jennifer. Identical twins. Born in 1945. Both turned 35 in 1980. Both inherited exactly $50,000 from parents. Both wanted to invest it for retirement. Same age. Same amount. Same starting point. But they made opposite choices that changed their lives forever. Sarah reads the newspapers. Inflation is out of control. The dollar is collapsing. Gold is soaring. Everyone's talking about it on TV. She takes her $50,000 and buys gold at $850 per ounce. She gets about 59 ounces. She locks it away and feels smart. Jennifer talks to a financial advisor. He tells her to invest in an S&P 500 index fund. She's nervous because stocks feel risky. But she trusts the data about long-term returns. She invests her $50,000 and tries not to look at it. She's scared but committed. 20 years pass. It's now the year 2000. Sarah and Jennifer are both 55 years old. They're planning retirement in 10 years. They both check their investments for the first time in 2 decades. What they discover will shock you. But I can't tell you yet. Because first, you need to understand what happened to gold and stocks during those 20 years. And I promise you, it's not expected. Let's start with the big picture. The last 50 years. From 1974 to 2024. This covers everything. Multiple recessions. Every major crisis. The dot-com crash. The 2008 financial crisis. COVID. Everything you can imagine. Every market condition you could possibly face as an investor. In 1974, gold was trading at around $160 per ounce. If you invested $10,000, you could buy about 62 ounces of gold. Now fast forward to 2024. Gold is trading around $2,000 per ounce. Your 62 ounces are worth $124,000. You turn $10,000 into $124,000. That's a 1,140% return over 50 years. Sounds incredible, right? Gold bugs are nodding their heads right now saying, "See? I told you so." But hold on. Before you run out and buy gold, you need to see what happened to the other option. This is jaw-dropping. That same $10,000 invested in an S&P 500 index fund in 1974, with dividends reinvested, is worth something very different in 2024. And when I tell you this number, you're going to think I made a mistake. You're going to rewind this video to hear it again. Are you ready? That $10,000 is now worth approximately $2,300,000. $2.3 million. Let me say that again because it sounds impossible. The same $10,000. The same 50 years. Gold turned it into $124,000. Index fund turned it into $2,300,000. Think about that difference. The index fund didn't just beat gold. It destroyed gold by a ratio of 18.5 to 1. For every dollar gold made, index fund made $18.50. Now you're probably thinking, okay, index funds win. Case closed. I'm never buying gold. But wait. Not so fast. There's more to this story. Because I'm about to show you a 12-year period where this entire story reverses. Where gold crushes stocks. And it's coming up soon. But before we get there, we need to adjust these numbers for inflation. Because the question isn't which made more money? It's which beat inflation. Over those 50 years, cumulative inflation was about 560%. That means you need $66,000 in 2024 to buy what $10,000 bought in 1974. So let's see what really happened. Gold turned your $10,000 into $124,000. But adjusted for inflation, that only has the purchasing power of $18,700. You beat inflation, but only by 87%. You nearly doubled your purchasing power in 50 years. Which sounds okay until you see this next number. The index fund turned your $10,000 into $2,300,000. Adjusted for inflation, that's like having $347,000 in 1974 dollars. You beat inflation by 3,370%. You multiplied your purchasing power by 34 times. This is the number that changes everything. 34 times versus less than 2 times. But here's where the gold investors stop me and say you're cherry picking. You're showing the best case for stocks. That's not fair. And you know what? They're right. There is a period where gold absolutely destroys index funds. And I'm about to show it to you now. This is the period that gold bugs point to every single time. They're proof. They're evidence. And honestly, they have a point here. From 2000 to 2012, gold had one of the greatest runs in history. This was the commodity supercycle. Gold went absolutely vertical. Gold went from $280 per ounce in 2000 to over $1,700 per ounce in 2012. If you invested $10,000 in gold, you had $60,700 by 2012. You multiplied your money by 6 times in 12 years. Incredible returns. People who owned gold felt like absolute geniuses during this period. Now here's what happened to stocks during that exact same period. The dot-com bubble burst. 9/11 happened. Then 2008 financial crisis nearly destroyed everything. It was a brutal, devastating time for stock investors. People watching their retirement accounts get cut in half. Twice. Within 1 decade. From 2000 to 2012, the S&P 500 with dividends reinvested turned $10,000 into about $16,800. You barely made any money at all. You basically kept up with inflation and that's it. Gold crushed stocks. It's not even close. This is the 12-year period I warned you about. If you owned gold during this time, you felt like a genius. If you owned stocks, you felt like an idiot. Gold clearly won. This is the period gold investors talk about. This is their proof. And honestly, they're right. During this specific period, gold was the winner. But here's what they don't tell you. And this is the part that changes the entire story. What happened next will surprise you. From 2012 to 2024, the tables turned dramatically. The S&P 500 more than tripled. Gold went from $1,700 to $2,000. It barely moved. Your $16,800 in stocks from 2012 became about $56,000 by 2024. Your $60,700 in gold became about $71,000. The gap narrowed massively. And this reveals something critical about gold. Something most people don't understand. Gold can go sideways for decades. Actual decades of nothing. Remember Sarah and Jennifer? The twin sisters from 1980? It's time to reveal what happened to them. And I warn you, this is emotional. Sarah bought gold in 1980 at $850 per ounce. She bought 59 ounces with her $50,000. She locked it away for 20 years. 20 years later in 2000, she checks the price. Gold is at $280 per ounce. Her $50,000 is now worth $16,520. She lost 67%. But it's worse. Much worse. Inflation from 1980 to 2000 was about 120%. She needs $110,000 to have the same purchasing power. She has $16,520. She lost 85% of her purchasing power. 85%. By choosing what she thought was the safe inflation hedge. Her sister Jennifer invested in the S&P 500. That $50,000 grew to about $700,000 with dividends reinvested over those same 20 years. Adjusted for inflation, that $700,000 has the purchasing power of about $318,000 in 1980 dollars. Jennifer multiplied her purchasing power by 6.4 times. Same starting point. Same amount of money. Same time frame. One sister retires wealthy. One sister's retirement is destroyed. All because of this choice. This story is real. These scenarios happened to millions of people who bought gold in 1980 thinking they were protecting themselves from inflation. Now, gold investors will say, but gold works during crisis. When the system breaks down, gold is king. And they're actually right about this. Let me show you when. In the 1970s, chaos everywhere. The US abandoned the gold standard in 1971. Oil prices quadrupled overnight. Inflation hit 13% in 1979. The dollar was in free fall. People were panicking. The financial system looked like it might collapse completely. Gold went from $35 per ounce in 1971 to $850 in 1980. That's a 2,329% gain in 9 years. Absolutely insane returns during crisis. Meanwhile, stocks went nowhere for 14 years. From 1968 to 1982, the stock market was basically flat. Gold was the clear winner during crisis. So here's the pattern. And this is critical. Gold works when people panic. When faith in currency breaks down. When inflation combines with geopolitical crisis. But here's the problem. Most of the time, we're not in crisis mode. Most of the time, we have normal inflation in functioning markets. And in normal times, stocks beat gold by massive margins. Let me show you exactly how massive with long-term data that doesn't lie. If we look at every 30-year period since 1928, stocks beat gold in 95% of those periods. The average 30-year return for stocks is 2,600%. The average for gold is about 380%. After adjusting for inflation, stocks average 8% real returns annually. Gold averages 2% real returns annually. Here's what that means for you. If you invest $100,000 at age 35 and hold until age 65, in gold at 2% real returns, you have $181,000. In stocks at 8% real returns, you have about $1,006,000 in today's purchasing power. You beat inflation 5.5 times more with stocks than gold. But I can hear the objection already. What if I buy at the peak and crash happens right when I retire? Stocks are too risky. Here's the truth bomb. Gold has the exact same risk. If you bought gold in 1980 at $850 and needed money in 1990, it was $380. You lost 55%. Stocks doubled during that same period. If you bought gold in 2011 at $1,900 and needed money in 2015, it was $1,050. You lost 45%. Stocks were up 70%. Gold is not safer than stocks. Gold's volatility is actually higher than the S&P 500 over most periods. The idea that gold is safe is a complete myth. Gold crashes just like stocks. Sometimes worse. But it doesn't have the recovery power. So which one should you own? Here's my answer based on the data. If you're investing for 20 plus years and want to beat inflation, index funds win. The data is overwhelming. For retirement investing, stocks destroy gold over long periods. It's not even a debate when you look at the numbers. If you want insurance against financial collapse or currency crisis, own some gold. Maybe 5% to 10% of your portfolio. Not as an investment. Here's what I personally do. I keep 5% of my portfolio in gold. Not because I think it will outperform, but because it's crisis insurance. If we have a 1970s style crisis, my gold protects me. If we don't, my 95% in stocks massively outperforms and the gold doesn't matter. Let me show you this with numbers. You have $100,000 to invest for 30 years. Option A is 100% gold. Option B is 100% stocks. Option C is 10% gold, 90% stocks. After 30 years at historical averages, Option A gives you $432,000. Option B gives you $1,745,000. Option C gives you $1,614,000. Option C is only 7.5% less than Option B, but you have crisis insurance. You're protected on both ends. Here's the bottom line. Gold is not the inflation hedge people think it is. Over long periods, stocks beat gold by massive margins every time. The data doesn't lie. The numbers are clear. For 90% of people, in 90% of scenarios, index funds are the answer to beating inflation. But gold has a role as crisis insurance. A small allocation makes sense. But it should be small, not your entire strategy or retirement plan. For most people, most of the time, index funds are the clear winner. But own some gold if you're worried about the worst case 10%. If you found this valuable, subscribe because I release videos comparing investments with real data, not hype or opinions or sponsored content. I've created a free gold versus index fund calculator showing historical performance of different allocations. You plug in your numbers, it shows you outcomes. Link in the description. Drop a comment. Do you own gold, index funds, or both? And why? I'm genuinely curious what your strategy is. Remember, the best inflation hedge is owning productive assets that grow over time. For most people, most of the time, that's index funds building wealth. Thanks for watching, and I'll see you in the next video where I break down another investment myth with real data.